Okay, so you want to own a bank. Sounds like the dream, right? People walk in and hand you their money. You lend that money to somebody else at a higher rate. You keep the difference. You sit back and you get rich. That is, on paper, exactly what a bank does. The problem is everything that lives in the gap between that sentence and reality. What it costs to get in. What it costs just to keep the doors open. What happens the moment the math turns against you. And why some of the most experienced people in all of finance have watched banks they spent decades building disappear in a single afternoon. So let us start at the very beginning. Not with the vault, not with the interest rate. Let us start with something simpler. What a bank actually is. Because almost everyone pictures the wrong thing. Most people imagine a bank as a very secure room. You bring your money in, they guard it, you take it out when you need it. That is not a bank. That is a locker. A bank is a machine that turns other people's money into things that produce income. Every dollar you deposit is not sleeping in a box with your name on it. The second it lands, it goes to work. Think about it the way you would think about any other business. A bakery takes flour and turns it into bread. A steel mill takes iron ore and turns it into car parts. A bank takes your deposits and turns them into loans, bonds, and investments that earn money every single day. The raw material is other people's cash. The product on the shelf is credit. And here is the detail that makes banking genuinely different from almost any other business on the planet. When the bakery sells the bread, the flour is gone. When the bank lends out your deposit is still there. You can still see it when you log in. You can still pull it out tomorrow. As far as you are concerned, nothing has moved. But the bank has quietly lent most of it to a stranger across town. This is not fraud. It is called fractional reserve banking, and it is the foundation underneath every modern economy on Earth. Here is the mechanism. You deposit $100. The bank does not lock away $100. It keeps a slice, lends out the rest, and runs on the simple bet that most people do not ask for everything back on the same day. For most of American history, banks had to hold 10% of deposits in reserve. So for every $100 in, 90 could go back out as a loan. That 90 gets spent. Whoever receives it deposits it at their own bank. That bank keeps 9 and lends out 81. And the cycle repeats, again and again. A single $100 deposit can end up supporting somewhere close to $1,000 moving through the economy. That is not a trick. That is arithmetic. And it is the reason an economy can grow without the government physically printing a fresh bill every time somebody wants a loan. In March of 2020, the Federal Reserve did something that surprised a lot of people. It eliminated reserve requirements entirely. Today, American banks are not legally required to hold any specific percentage in reserve at all. Instead, the Fed simply pays banks interest on the money they choose to park at the central bank, which nudges them to hold reserves without ordering them to. The rulebook has shifted toward what are called capital requirements, which we will get to. But the core idea has not changed 1 inch. Banking runs on trust. The entire system rests on the assumption that not everyone will ask for their money back at the same moment. When that one assumption cracks, everything built on top of it cracks with it. So you still want to start a bank. How much does it cost? This is where the first trapdoor opens. You might guess the answer is a big pile of cash and a nice building on a corner. The real answer is that before you accept a single deposit or write a single loan, you have already spent somewhere between $2 and $30 million depending on the kind of bank you are building. And you have burned somewhere between 1 and 3 years drowning in paperwork. Here is why. Starting a bank requires permission from at least 2 separate regulators, not 1. You have to apply for a charter, either a federal charter from the Office of the Comptroller of the Currency or a state charter from wherever you plan to operate. Then, completely separately, you have to apply for deposit insurance from the Federal Deposit Insurance Corporation, which everyone just calls the FDIC. Both applications demand exhaustive documentation, your full business plan, your management team, your risk framework, your capital projections. Detailed background on everyone with a hand on the wheel. And the FDIC does not hand out approval to anyone with a pulse and a checkbook. It refuses to insure banks it believes have a poor chance of surviving. So your application has to prove not just that you have money, but that you have a realistic, coherent plan to keep the thing alive. And then there is capital. Now, pay attention here, because this is where most people get confused. Capital is not the same thing as deposits. Deposits are money you owe your customers. Capital is money that belongs to the bank itself. It is the cushion that soaks up losses when things go wrong. Under current Federal Reserve rules, a large bank has to hold a minimum core capital of 4.5% of its risk-weighted assets, plus an extra buffer of at least 2.5% on top. For a smaller community bank, regulators generally want to see a leverage ratio somewhere around 9 or 10%. In plain terms, if you want to build a modest community bank capable of making $100 million in loans, you need to walk in the door with roughly $10 to $15 million of your own money first. That capital cannot be borrowed. It cannot come from deposits. It has to be genuinely yours. And that is before you lease a building, hire a soul, buy a single piece of software, or pay the lawyers who will spend months guiding you through the maze. We have not made one loan. We have not collected $1 of interest, and real money is already gone, spent purely to earn permission to open. Now the doors are open, and the costs are only getting started. First, people. A working bank needs loan officers, compliance officers, risk managers, branch staff, IT teams, cybersecurity teams, auditors, and senior management. Even for a small community bank, payroll alone runs into several $1,000,000 a year. For a large regional bank, it is hundreds of millions. J.P. Morgan Chase, the biggest bank in the country, spent more than $22 billion on non-interest expenses in a single quarter of 2024. That is expenses, not counting a cent of the interest it pays out to its own depositors. Second, technology. Banking is one of the most technology-heavy industries that exists. Every transaction has to be recorded, verified, and protected. Fraud never sleeps. Cybercrime never sleeps. A single data breach can cost a bank hundreds of millions in fines, legal fees, and customers who walk out and never come back. The largest banks now spend billions every year on cybersecurity alone. Third, compliance. Banking is among the most heavily regulated activities on the planet. Anti-money laundering rules, fair lending laws, consumer protection regulations, stress tests. Every quarter and every year you are filing detailed reports with several agencies at once. Employing enough lawyers, auditors, and compliance officers to stay inside all of those lines is, for a big bank, one of the single largest costs it carries. Fourth, and this is the quiet one, the cost of loans that never come back. Every time a bank lends, some slice of that money is gone forever. The borrower loses a job. The business folds. The property crashes. Banks are required to set money aside in advance for exactly these losses. They are called loan loss provisions, and in a bad year they can swallow an enormous chunk of what would otherwise have been profit. Add it all up, and the picture sharpens. Before a bank earns $1 of revenue, it is already carrying a mountain of fixed costs that run every single day, whether the loans are performing or not. So how does the money actually come in? The engine of the whole thing is a number called the net interest margin. You borrow money cheaply from your depositors, you lend it out expensively to your borrowers, and the gap between the two is called the spread. That spread is the entire engine. A savings account might pay a depositor almost nothing. A credit card might charge that same customer more than 20%. A mortgage sits somewhere between 6 and 8% for most buyers right now. The bank plants itself in the middle of all of it and collects the difference. If a bank holds a loan portfolio of $500 million and earns an average net interest margin of 3%, that is $15 million a year in income before expenses. Sounds healthy. Then you subtract payroll, technology, compliance, insurance, the cost of deposits, and loan loss provisions, and what is left standing is the real profit. But lending is only the first floor. Over decades, banks have learned to pull income out of nearly every transaction they touch. There are account fees, monthly maintenance fees, wire fees, fees for cashier's checks, foreign exchange fees. There are overdraft fees, which one industry group estimated generated close to $10 billion across American banks and credit unions in a single recent year, and which regulators now circle like hawks because they see them as predatory. There are interchange fees. Every single time you swipe your card at a store, that store pays a processing fee, and the bank takes a cut. Across billions of swipes, tiny cuts become real fortunes. There are wealth management fees, where banks advise rich clients and charge a percentage of everything they manage. And for the giants, there is investment banking, helping companies raise money, advising on mergers, trading securities. In 2024, J.P. Morgan Chase earned a net profit of roughly $58 billion, the highest annual profit in the history of American banking. Read that number again. $58 billion in a single year, and it exists for one reason: scale. The spread on any one loan is small. Multiply a small percentage across trillions of dollars in assets, and small becomes almost unimaginable. Here is what makes banking genuinely strange as a business. Most companies use their own money or borrowed money to generate a return. A restaurant owner puts in capital, buys the ovens, hires the cooks, and prays the margin on the food covers the investment. A bank runs almost entirely on other people's money. The deposits sitting in your customers' accounts are the raw material. You borrow them cheap, lend them dear, and the profit you generate sits on top of capital you do not even own. Bankers call this leverage, and it is the source of both banking's extraordinary profits and its extraordinary danger. When a bank earns a 1% return on $500 billion in assets, that is $5 billion. But measured against its actual equity, the thin sliver of money that truly belongs to the bank, the return can be 10, 15, 20% or more. J.P. Morgan's return on tangible equity in 2024 was around 22%. Almost no other industry on earth throws off numbers like that year after year, but leverage is a blade with two edges. When assets lose value, when loans default, when bonds fall, the losses do not land on the depositors first. They come straight out of that tiny layer of equity. A bank with $50 billion in deposits and $5 billion in capital only has to lose $5 billion, just 10% of what it owes, before it is technically insolvent. That is the trap sitting at the dead center of the entire business. The exact same thing that makes a bank so profitable is the thing that lets it collapse so fast. But before we watch a bank die, there is one more piece you have to understand, because it is the accelerant under every modern bank run: deposit insurance. When the FDIC insures your account, it only insures it up to $250,000 per depositor per bank. Everything above that line is uninsured. If the bank fails, that money is not guaranteed to come back. Now think about who keeps far more than $250,000 in a single checking account. Not ordinary families. Companies do, startups do, wealthy individuals do, and that is exactly where the danger concentrates. When a bank's deposits are mostly small and insured, its customers have no reason to panic because the government has their back no matter what. But when a bank's deposits are mostly large and uninsured, every one of those customers has a powerful reason to run at the first hint of trouble because they are the ones with everything to lose. This is the hidden fault line that decides how fast a bank can fall. A bank stuffed with insured deposits is slow to burn. A bank stuffed with uninsured deposits is a room full of dry timber waiting for a spark. Keep that in mind, because the banks that vanished fastest in modern history were the ones sitting on the highest share of uninsured money. Let me show you how fast. Silicon Valley Bank had around $209 billion in assets at the end of 2022. And here is the detail that made it so flammable. The overwhelming majority of its deposits, well over 90%, sat above the insurance line, uninsured. It was the 16th largest bank in the United States. It had been operating for 40 years. It was gone in 44 hours. The story is almost mechanically simple. Silicon Valley Bank served tech startups and venture capital firms. Between 2020 and 2021, its deposits roughly doubled as cash flooded into the startup world. SVB took much of that money and poured it into long-term government bonds, which paid a little more than short-term ones. That was not reckless. Government bonds are the safest instrument in the world. The problem was the duration. Long-term bonds lose value when interest rates rise. And when the Federal Reserve began raising rates in 2022 at the fastest pace in 4 decades, the market value of SVB's bond pile fell off a cliff. By the end of that year, the bank was sitting on roughly $17 billion in unrealized losses on bonds it was pretending it would simply hold forever. At the same time, the tech world was contracting, and its startup customers were burning cash and pulling money out. On March 8th of 2023, SVB announced it had sold a chunk of its portfolio at a nearly $2 billion loss and was scrambling to raise capital. That announcement lit the fuse. Venture capitalists started texting each other. Group chats went off. Funds told their startups to pull everything. By the close of the next day, customers had tried to yank $42 billion out in a single day, nearly a quarter of the entire bank. On March 10th, regulators seized it. What killed Silicon Valley Bank was not bad loans. It was interest rate risk colliding with a depositor base so tightly connected that when fear spread, it spread at the speed of a text message. And SVB was not alone that spring. Weeks later, First Republic Bank, a lender to wealthy clients with around $229 billion in assets, went into the same spiral. After SVB fell, First Republic's customers pulled roughly $100 billion in deposits in a matter of weeks. 11 of the biggest banks in the country tried to save it by parking $30 billion of their own money inside it. It was not enough. On the 1st of May in 2023, regulators seized First Republic and sold it to, of all buyers, JP Chase, the second largest bank failure in American history, wrapped up over a single weekend. But the pattern is older than 2023. Meet Kerry Killinger. For 17 years, he ran Washington Mutual, which everyone called WAMU. By 2007, it was the largest savings bank in the country, with more than 2,000 branches, tens of thousands of employees, and $188 billion in deposits. Killinger understood mortgages. He understood retail banking. He understood his customers. But WAMU had pushed hard into subprime mortgages, loans to borrowers with weak credit at higher rates. The logic was that the extra interest more than covered the extra defaults. For years it did. Then home prices, which had only ever gone up, started falling in 2006. Borrowers who could no longer pay had no equity left to sell out of. Defaults piled up. On September 15th of 2008, Lehman Brothers filed for bankruptcy, and the fear hit every depositor at once. Over the next 10 days, WAMU's customers withdrew $16.7 billion, more than 11% of the whole bank. On September 25th, regulators seized Washington Mutual and sold it to JP Chase for $1.9 billion. A bank with $188 billion in deposits sold for less than $2 billion. The shareholders were nearly wiped out. And here is the more important question hiding under all three of these stories. How does an experienced person, someone who built a bank over decades and understood the business intimately, end up presiding over its collapse? The answer is not personal stupidity. The answer is structural. Every one of these banks was profitable right up until the afternoon it was not. The thing that ends banks is rarely one bad loan. It is that confidence itself is fragile. A bank can be technically solvent in the morning and facing a fatal run by dinner. Not because anything real changed in the business, but because enough people decided, all at the same time, that they were afraid. So let us name the variable sitting beneath everything else: interest rates. The Federal Reserve sets the rate at which banks lend to each other overnight, and that one rate ripples into nearly every other rate in the economy. When it rises, the cost of holding on to deposits rises. When it falls, the income from loans falls. Banks try to defend themselves through something called asset-liability matching, which is a fancy way of saying they try to line up the timing of their loans with the timing of their deposits. If you fund 30-year mortgages using short-term deposits, you are exposed. When rates jump, what you pay your depositors goes up immediately, but the income from those old mortgages stays frozen at yesterday's rate. That mismatch does not always look dangerous from the outside. WAMU looked fine until it did not. Silicon Valley Bank looked fine until it did not. The entire economic weather of the business can be changed by a committee in Washington that meets 8 times a year. That is the volatility trap. The model works beautifully in the right conditions, and the conditions are not always right, and they can flip faster than any bank is built to survive. So let us run the actual numbers, the way an owner would. Say you did everything correctly. You raised $15 million in starting capital. You got your charter and your deposit insurance. You opened your doors. You built a $100 million loan portfolio earning a 3% net interest margin. That is $3 million a year in interest income before expenses. Add in fees from accounts, wire transfers, and card processing, and your gross revenue is around $3.7 million. Now start subtracting. Payroll for a bare-bones team of 15 people, $1.8 million. Core banking software, $400,000. Compliance and legal, $300,000. FDIC insurance premiums, $80,000. Loan loss provisions for a normal default rate, $300,000. Physical space and overhead, $200,000. Your net profit is roughly $600,000, which means to earn back your $15 million investment at that pace, you are looking at somewhere around 24 years. And that is the good scenario. Now, the bad one. Rates rise 2 percentage points while half your loans are locked in at fixed rates. Your deposit costs jump right away because depositors chase higher rates elsewhere. Your net interest margin compresses from 3% down to 1.5%. Your interest income falls from $3 million to $1.5 million. Your expenses do not move an inch. You are now losing money every month, or a recession hits instead. Unemployment climbs. Borrowers default. Your loan loss provisions jump from $300,000 to $1.5 million. Same result. You are bleeding every month. The gap between a good year and a bad year on a bank this size is around $2 million. That sounds manageable until you remember your entire capital cushion is only $15 million. 2 bad years back to back, and you have burned through more than a quarter of it. 3 bad years, and the regulators are standing in your lobby asking questions. So, does owning a bank actually work as a business? The honest answer is that banking is one of the most consistently profitable industries in the history of commerce, right up until it is one of the most catastrophic. J.P. Morgan earned $58 billion in a single year. The oldest and richest families in European history chose to own banks instead of factories because they understood something that is still true today. When you sit in the middle of the flow of money, you collect a toll on nearly everything the economy does. But banking has also produced more spectacular collapses, more devastating losses of other people's money, and more government rescues than almost any other business humans have ever invented. And the reason is always the same word: leverage. It amplifies the good years, and it amplifies the bad ones. And the bad years in banking do not arrive slowly. They arrive in 10 days of withdrawals. They arrive in 44 hours. They arrive on the morning a venture capitalist fires off one message to a group chat. So if you do decide to own a bank, understand exactly what you are buying. You are not buying a vault. You are not buying a calm, predictable stream of income. You are buying a machine that turns trust into money and runs entirely on the assumption that the trust never, ever runs out. The moment it does, no capital cushion in the world moves fast enough to save you.